Hi everybody, this is Tor Storley and I am back with another video. So in this video I'm going to take a look at a bond analysis, and I want to use my community extension that we created for DuckDB to perform some of these calculations and display some of the output. The first thing I want to do is introduce you to bonds and what is a bond versus what is stocks, etc. as an investment. And also in this video series, I should say, it'll be more than one video. I will start with a primer so you can understand the language of bonds. And also I will show you how to use the DuckDB bond calculations, how to calculate the price of a bond, etc., using the information. We can also perform some accounting journals, which will be interesting, which I haven't done in ages because my background is in finance and accounting, not so much IT. So I drifted into IT development after I took all my finance and accounting certifications. I took a few certifications. I hold a certified public accountant here in the US from the state of Ohio, which is CPA license. And I'm not active, so I'm not going to claim I'm active. I'm in active status. And I took something called a certified in management accountant, which is the opposite. A CPA works with historical data. You might have heard of audit reports where auditors come into a company and they perform audits for the financial records of the company, which is basically historical records. So they typically do that in the first quarter of the following year. So they go through all the stuff and then they issue an opinion if it's, valid according to general accepted accounting principles, or they qualify their opinion. So in this video, we're going to focus on the long-term liabilities, or so-called bonds. There are notes, etc., and so forth. And we're not going to focus too much on all the details, but we're going to basically do some bond calculations. It was a nice way for me to going back to that. It's been a while since I even looked at this stuff, and you forget stuff. So it was nice to refresh my memory on some of this material I used to teach many, many years ago. So yeah, so in this video series, I will go through calculating bond amortizations. I will calculate bond prices. I will talk about bonds in general, what it is, and I will put it in plain English so you can follow it. It's not going to be technical jargon. And then we'll look at some accounting entries, and you can see how accountants will perform and calculate this. So let's take a look at it. I created a couple of documents, and we'll go through some of those with the help of Claude, obviously. So it'll be a lot faster and a lot easier to create some content. So I created this document here along with Claude, and we'll go through some of the basics of bonds, and we'll discuss those, and that will be this video. The next video we'll look into how you can create, bond amortization schedules, etc. So let's get through this and make sure we understand what we're dealing with here. So what is a bond? Well, it's basically a loan. Instead of borrowing from a bank, you can have a company borrowing from, literally thousands of individuals or institutional investors. When you buy a corporate bond, you are the lender. You lending money to the company, which they need for their operations, etc. So it's a way for them to create financing. So the company is therefore the borrower, and you are the lender, along with those thousands of other people who gives money to this company. So in return, what do you expect? Well, you're going to lend them money, so you expect to have some kind of return. And in a bond issue, you're looking for something called a coupon or stated interest rate, and sometimes called a nominal rate as well. Now, that is a fixed rate that you're going to multiply by the face value of the bond, and that will be the payment they're going to pay on a periodic basis. So typically it's semi-annual, okay? And then, in addition to all those so-called coupon payments, which are interest payments to you from that company, they will return you the principal, the face value of the bond contracted issue, meaning the whatever they put into their bond contract, that will be the face value. And they will return that whole value, but that will happen on the maturity date. Okay, so there's a few things happening here. So for example, here you can see a simple example. Let's say you have Apple that needs $5 billion to fund a new manufacturing facility. So instead of them taking out a bank loan, they issue 5 million bonds, and they typically are at a $1,000 each level. Now they vary a little bit, but that's very typical. And therefore, investors that want to be part of Apple here to buy these bonds, they will buy them. And Apple, and of course, depending how much you want to invest, it's going to determine how many bonds you buy, because they're $1,000 each, right? So what I'm looking at here is that Apple will have to pay each bondholder 4% annual interest, because that's the coupon rate. Coupon rate will be stated on the bond certificate. There'll be a fixed rate. If it's 4% annual, that will be 2% semi-annual. So the present value calculations apply to these bond issues. So if you're going to pay twice a year, you'll have to cut that rate in two, and you have to multiply the number of periods by 2. This 4% annual rate is really 2 per 6 months. And therefore, that's $40 per year, or in other words, $20 per 6 months. And then at the end, they will return the $1,000 principal after 10 years. Okay, so what is the difference between stocks and bonds? What are some of the things that you should be aware of? Well, ownership is a key word. So what does that mean? Well, when you buy a stock, you own a portion of the company. You don't own anything when you're a bondholder, because you are lending the company money. So you have no ownership in the company. But when you buy your stocks, you buy in a portion of the company. That's basically what the stock means. So what about your returns? Well, stocks pay dividends if they pay dividends. Sometimes, startups, they don't pay dividends because they need to maintain their funding. They need to keep all the money so they can reinvest it into their business operations. However, bonds will have to pay a fixed coupon payment. So what is the risk then? Well, if the stock performs bad, it will drop, right? So you can lose a lot of money. I had a case where I bought this ARKG stock for $93. I didn't spend a lot of money on it, but I think I put $5,000 into it. But that went from 93, and right these days is trading around, I don't know, maybe $35 or $40 at the most. So I lost on that one. But I had other investments, like the Palantir investment I did many, many years ago. That one, that went from, when I bought it at the IPO, value of a little bit over $10, I think I paid. That one went up to, well, now it was up to over $200 for a while. But I cashed out around 70, 75, something like that. So I still earned a lot of money on that stock, but you never know. So you could lose a lot of money, okay? So what is the upside then? Well, on stocks, the upside could be dramatic, or you can lose your stocks, right? That's like I said. On the bond investment, you will get that coupon payment, which is a fixed payment. It's a contracted payment. So you get your money back unless there is some things happening to the company, like a bankruptcy, etc. We'll talk about that a little further down. So here you can see, if you go bankrupt, you'll be the last in line to get your money if you're a stockholder. You'll be the first in line if you are a bondholder over the stockholders. There's typically a pecking order, and the bondholders will always get paid first in line of the preferred stockholders. And then, of course, the common stockholders get paid last, whatever is left over. So they get all the spoils. What about the certainty of income? Well, there is none, okay? You can cut, the company can cut the dividend, so you earn nothing on it. So the only thing you're going to have going for you is the capital gains on the stock value itself. So if you buy for $10 and it goes up to $15, you have a $5 capital gain. For the bonds, you can, because this coupon is contractually fixed, that you are going to have income. That's a high percentage certainty of getting money. So here you can see, however, stocks are typically more profitable than bonds because they, if it goes up, there's a higher risk, obviously, but there's also a higher potential return. So that's why stocks might be the thing you want to invest in when you're young and you have several years to let it grow. Once you get towards retirement age, however, if you want to maintain the values of your investments, you might kind of gradually switch over and buy more bonds that are more secure investments and cut down on all the stocks, okay? But, you never know. I hold stocks myself in form of 401k investments, etc. And I'm still in stocks, so I'm not going to give that up. And they have been very good, so I'm not going to just dump that and buy a bunch of bonds. But bonds are a way of diversifying your risk, okay? Keep in mind, this is not an investment advisory video. So whatever I say here is simply for teaching purposes. Has nothing to do with me giving you advice and what to invest in, okay? The key takeaways, therefore, is bonds are not very exciting. They're very predictable. And they're very good if you want to predict your steady income. Even though it might not be a lot, it will still be predictable. So in other words, if you're a retiree, if it's a pension fund, I used to work in a pension fund, and I worked in international investments. And yes, we did things like equity swaps where we swapped the equity index funds that we had, like typically from Japan, the Topics Index. All those dividends were calculated as a percentage, and we swapped it with big investment firms like JP Morgan and Credit Suisse, etc. And they were paying us in fixed income. So that was a way to get around some of these requirements for these funds. Plus, you don't have to invest in those bonds yourself. You just kind of swap the returns, etc. But that's another story. Okay, so how do you issue corporate bonds? Well, you use typically an investment bank. That's the middleman, okay? So the company doesn't sell it directly, okay? They typically hires an investment bank like Goldman Sachs, JP Morgan, Morgan Stanley, or Bank of America, or Citigroup. Their task is to structure a deal, price the bonds, and when I say price the bond is to figure out what is the going yield rate, meaning what is the going market rate for similar bond issues. So you might want to, for the maturity of 10 years, you have a certain coupon rate. What is the current 10-year yield? What is the current treasury bond 10-year yield, and so forth. So they will have to price the bond to figure out how much that it should be selling. And when they sell a bond, you typically sell it either at par, as it's called, and that means that your yield and your coupon rate are the same. If you're selling with a yield higher than the coupon rate, you're selling at a discount. And we'll get into why that is. And the same is true with a premium. You sell it at a higher price if the yield goes below a coupon rate. So there's an inverse relationship between the bond price and its yield in relationship to the coupon rate. Also, these investment banks, they will do what is called a build-a-book. And you can see it here. They have to figure out the demand for this to figure out how they're going to price it. They will have to figure out a way of distributing these bonds. And they will have to either maybe buy it up themselves and then sell it to other investors. So there's a lot of things that goes into this. But why would they do this? Well, look at this. If you want to earn some money, like an underwriting fee, typically between 0.5% and 1.5% of the total offering size, on a $1 billion bond issue, in our case with Apple, the $5 billion one, you can see that would be quite profitable. They will charge something like $5 million to $50 million in fees. So it might be worthwhile doing this. What is firm commitment versus best effort? Well, a firm commitment is when the investment bank buys the entire bond issue at a guaranteed price and then resell it to investors. The best effort is when they only act as an agent and they try to sell as many bonds as they can at the best available price. Look at what a bond issue will entail. And it's not done in, on the same day or anything. It takes weeks to do this stuff. And if you look at these points here, you can see why. You have to hire an investment bank. You have to do due diligence and figure out the rating agency like Moody's or Standard & Poor's or what have you. They will have to rate and figure out what rating category you fall in, because it's very important what kind of rating you have, and that will determine how much the coupon rate will be, etc. Because if it's very risky, you might have to increase your coupon rate because the investors think it's risky, they want more return, etc. You have to register with the SEC. Then all these investment banks have to take it to the road. They have to go and pitch to potential investors. Maybe it's a pension fund. Maybe it's an insurance company, what have you. And then they have to come up with a price and a close. And then the settlement will be whatever the cash they receive. So that's the kind of timeline. And as you can see here, it typically takes 8 to 12 weeks from the initial decision. And so it's not happening overnight. So a typically denomination then for the bonds is $1,000, which is called the par or face value. However, you can see things like $5,000, $10,000 in the secondary market. There's a little table here you can kind of get an idea. And again, this is just for informational purposes. So how do you determine the coupon rate? Well, typically when these investment banks are trying to price this bond, they will look for similar issues at the time that you want to issue it. And they will look at the current market rates. So, for example, there is a risk-free rate portion of the rate they determine to use. For U.S. Treasury bonds is typically, or U.S. Treasuries, I should say, is typically used as a risk-free rate. So, in other words, if you have a 10-year issue, for example, you might want to think about using the 10-year Treasury bond as a risk-free rate calculation or portion of that final rate you're going to use. And then you have the credit spread, which means you want to compensate for risk. Now, depending on what kind of status you have, what kind of rating you have, from AAA down to CCC, that will determine how much you're going to tag on to that risk-free rate, right? Very high grade, with very investment quality, like a AAA, like the Apples of the world or the NVIDIAs of the world. I think NVIDIA will fall there. You might have a AAA rating. But what happens then is you might add only 10 basis points. Now, what is a basis point? There are 100 basis points in 1%. So when you add 10 basis points to the risk-free rate, you're basically adding 1/10 of 1% to that risk-free rate. As the quality goes down, you have to add more to attract investors. And that's what this illustrates. These are not legit numbers, but they just give you an idea of how that could potentially work. So the market conditions at issuance is important too, right? So to find out how much the final coupon rate is going to be, you need to check out what's going on in the market right now. And if you look at it, for example, here, this example, if Apple is a AAA rated company, according to Moody's and Standard & Poor's, etc., one thing I want to point out here is that this all assumes that you are a believer in institutions and you trust them. Now, there's a lot of stuff happening in societies these days, and there was a lot happening under the financial crisis in 2008, if you recall. Rating agency was corrupted. They start giving a lot of the mortgages they bundled, they gave them high ratings. And of course, it was trash. You can't just blindly trust all this stuff because, if the rating agency, if you can't trust them, what's to say that the AAA rating is really a AAA rating? That was not the case in 2008. They were corrupt as heck, these rating agencies, because they were paid a lot of money. The excuse was that, hey, Standard & Poor's rated this bond AAA, so we need to keep up with them so we can compete. Yeah, okay. So junk stuff, they rated AAA. And you know what happened in 2008? There was a financial crisis across the world that almost bankrupted countries like Iceland. So in other words, let's say you trust it. Let's say you trust your government. Let's say you trust that the U.S. government's bonds will never go bankrupt or anything. And let's say that Japan and Europe and all the investors in US don't pull all their money out of Treasury, and therefore you say that this is as safe as it's going to get. Then you can use this Treasury yield, which is the risk-free rate on a 10-year bond, and then you can add this 10 basis point to it, which you saw up here, and therefore your new rate becomes 4.54. However, that you might have to work around the edges here. But that's how you can kind of set the coupon rate in this respect. All right, so what type of corporate bonds are there? There are secured bonds, there are mortgage bonds, there are equipment trust certificate. So let's look at those. Okay, and there's collateral trust bonds. So a secured bond is backed by specific assets pledged as collateral, much like you do with when you take out a mortgage on your house. Your house is the collateral, right? If you can't pay it, then the bank takes over the house. Here, you can take the company's assets. And the mortgage bonds are backed by real property, like buildings, land, and equipment. This is the most common type of secured corporate bonds. You can also have equipment trust certificates that are backed by specific equipment. Like in airlines, you have like aircraft. And there's also collateral trust bonds that are backed by financial assets such as stocks and bonds of subsidiaries. So these are kind of secured bonds. You have unsecured bonds, debentures. That's only backed by your good reputation, your creditworthiness as a company. So there's no assets that backs it up, in other words. So that's a little more risky probably because you just take their word for it, right? In reality, most investment-grade corporate bonds are debentures. So you trust the Apples, don't you? And the Microsofts and the Amazons. Do you? Well, I don't know. So anyways, those are huge companies. So they probably will be able to pay you a little better than some of the smaller companies and they issuing bonds, etc. Subordinate debentures rank below regular debentures. There's also convertible bonds, okay? And convertible bonds can be actually converted into stocks at a certain point in time. So that makes it interesting for some investors because they can basically turn their bonds into stocks at a certain point in time. And therefore, they're willing to accept a lower coupon payment in exchange for the conversion options. Now here you can see the typical yields, the risk levels, and the bond types. So I'll let you look at that. Then you have the bond indenture. What is a bond indenture? Well, it's like a bond contract. This is where they state everything that relates to the bond issuance. So it's a legal document. So this will be almost like a deed or a trust. And everything that matters should be in here. Everything should be listed out. And typically, as you can see here, it could be between 200 and 400 pages long, and it's issued with the Securities and Exchange Commission. Now, everything I'm saying here relates to the US, so I don't know how it would be in other countries. But I focused here because this is where I live. Also, a trustee, which is typically a bank or a trust department, will be monitoring the compliance on behalf of all the bondholders. So they are kind of working for the bondholders. Okay, so we are going to continue this in the next video. I want to keep them short. And if you like my videos, give me a like. Consider subscribing to my channel. It'll be fantastic. And I'll see you in the next video. Take care.